I'm Stephen Vacinek, Director of Investments here at North Star Resource Group. Today we're actually going to talk a little bit about the 2025 recap for the stock markets, and we'll talk a little bit about what we see kind of going forward for 2026. The big news last year is international markets actually outpaced the U.S. markets by almost double. The U.S. large cap S&P 500 market actually did just shy of 18% type of return. Small caps in the U.S. did almost 13%. Whereas internationally, international large cap has actually done almost 31%, and emerging market has done over 34%, so almost doubling what has happened here in the United States. The Liberation Day was the passage of tariffs, enacting them. We have seen a lot happen since that has transpired. We've seen additions, we've seen subtractions, we've seen punishments. At the end of the day, has created a lot more uncertainty than it has clarity in that respect. The takeaway, though, has been from the American consumer's perspective, 80% of tariffs have actually been absorbed by corporations at this point, so they have not been passed on to the American public. The third thing, the major thing that happened on the economic front last year was the Federal Reserve cut interest rates by 3 times. That's kind of a big deal because the Fed has been really conflicted between running their dual mandate. And that means keeping employment strong and also making sure that prices are in check. We have seen 3 interest rates cuts. We will probably continue to see more interest rate cuts next year. But those are kind of some of the major things that we saw transpire. One of the other big effects that happened last year was the One Big Beautiful Bill. That actually passed in middle of the summer. And a lot of that is going to have stem around taxes, and what we're going to start seeing there is actually going to transpire early here in 2026. So a lot of the enactment that's happened there will retro through 2025, but the actual impacts of it will be starting being seen and felt in 2026. For 2026, we're anticipating a pretty strong beginning to the year. Much of that is actually going to be inspired by the One Big Beautiful Bill. And that actually was passed in the middle of last year, but a lot of that is going to be the tax implications that'll be effective the beginning of 2026. It's actually going to act as a stimulus. What's happened is they have actually increased the amount of SALT taxes from the consumer perspective, and SALT actually stands for state and local taxes. That actually is going to increase from $10,000 up to $40,000, and that'll act as a stimulus on its own and inject a fair amount of money into the economy. That money will use to generate GDP and see nice growth in the United States. Most economists, though, are anticipating that after this stimulus in the first half of the year, the second half of the year will probably have some sort of a slowdown. We actually are also going to anticipate much more volatility than we normally have seen previously, especially over the last couple of years. We've had 3 years of very strong stock markets with minimal amount of volatility. This could be a year where some of that may change for a multitude of different reasons, from economic to geopolitical risk, etc. Many economists are expecting 2, maybe 3 Fed rate cuts in 2026. That may not go as well for fixed income, as it's pretty fully valued right now. Last year, fixed income did 7% return. A lot of that was anticipation of Fed rate cuts. So you may be not having much upside or downside and just mostly collecting coupon kind of going forward. Another spot is U.S. large cap. U.S. large cappers remain very expensive, particularly those mega caps that are fueled from AI generation and spending. So one of the things that we could see here is if that continues, those companies will continue to do well. But if there's some sort of a pullback or any kind of a correction, or they stub a toe in that space, could definitely see some sort of volatility or pullback just given the strength of that market. On the flip side of that, international stocks are actually very cheap right now. So we could see the potential for international, like it outperformed the United States this year. We could continue to see that happening for mostly because of the weakening US dollar, along with some of the tariff perspective, which may find countries trading around the United States. So we continue to look at international as a key portion to a portfolio. In addition to international, we also feel that emerging market could be a great place to be going forward, not only from the weakening dollar, but also from artificial intelligence fueled commodity prices that would benefit them dramatically. Another place to kind of look at has been the alternative space. Alternatives have become much more advantageous for retail and smaller accounts to own, given the evergreen and interval fund structures. So there's some opportunities right now where alternative investments may play a portion in your portfolio and can help further diversify. Thank you very much for your time today. If you have any further questions regards, please feel free to reach out to your advisors, or you and your advisor can feel free to reach out to the investment department here at North Star Resource Group. Thank you, and all the best to a prosperous new year.